Hello and welcome back to the Property Trio. I'm Kate Bakos, joined as always by Dave Johnston and Mike Mortlock. And today we're digging into a topic that's reshaping the property market, whether we like it or not. It's climate change. From skyrocketing insurance premiums to suburbs becoming uninsurable, this is about risk, cost, and the future of housing.
And Kate, it's one of those things that's no longer just a headline. It's hitting homeowners and investors and it's hitting their hip pockets. The data is starting to show where the biggest impacts are.
It's exactly right, Dave. Like climate scientists and insurers are both saying the same thing. More than 2 million properties in Australia are already at moderate to high risk. That's not 2050. It's actually right now. So I thought this was a good time to talk about this. We're not talking about the debate about whether it's overcooked or any sort of lack of scientific consensus. We're talking about real impacts on properties and property prices and what it actually means for property owners. So I think it's an important conversation.
Yeah, I do too. And I know that you let the cat out of the bag with a couple of our listeners, our favourite listeners out there, Mike, and they're kind of on the edge of their seat waiting for this. What I wanted to share with our listeners is that you've also prepared a checklist. So we've got that to hand out to our listeners. All they need to do is just email us at info@thepropertytrio.com.au and I'll get it straight over to them, and I'll pop a link in the show notes as well. But to get started on this, I won't say exciting app, it's a terrifying app. Let's talk about the scale of the risk first. And I want to start with the Climate Council data, Mike. What are we talking about here?
Yeah, the Climate Council of Australia published an At Our Front Door report in 2022, and that painted a very stark picture. So back then they projected that by 2025, right now, 652,000 homes would be considered high risk, where insurance is often unaffordable or even unavailable. Well, we're here now in 2025 and looking at what's happening in places like Hawkesbury and Brisbane, those projections weren't very far off the mark.
Yeah, and the same 2022 report projected another 1.55 million homes would be at moderate risk, meaning abnormally high premiums. So that was 1 in 10 Australian homes, and we're seeing that bear out in the insurance data, and premium spikes right now. And actually, I don't know if you guys saw, but the government's National Climate Risk Assessment report was just literally published on Monday. So the 15th of September, and noted that if populations remain as they are today, more than 1.5 million people will experience sea level rise and coastal flooding risks by 2050, with seawaters inundating coastal infrastructure, homes and drinking water supplies. And I can say, going for my run up towards the National Park in Noosa this morning, the ocean's really washed away one set of units where they're having to be held up by pillars and wires, and they're sort of hanging over the edge because they were built right on the beachside. So, and this report foreshadowed losses on property values of $611 billion by 2050 and warned of a risk to the financial system itself.
It's funny, isn't it? Because you hear these things like, oh, the sea level will rise by 3 centimetres, and you're like, 3 centimetres? Like, what difference does that make? But it's not necessarily the sea level rise in isolation. It's the extreme weather events as well. And when that coincides with rain and a king tide, those coastal areas are super prone to flooding. Even Newcastle here, where I am, we've had major flooding events. And we're not necessarily
warmer
talking...
ocean by just a degree or two can make a huge difference to weather patterns.
Yeah. And we're not necessarily talking about, people having to be worried about total loss of their dwelling. Certainly it is a factor, but the focus for this, for me, is really around the cost of insurance and what these floodplain areas that are being identified can actually mean to a property investor or a homeowner in terms of the value of their property. And we've got some good data to share on that.
The dominant threat identified in that 2022 work was riverine flooding, and about 57% of those high-risk homes in the worst electorates were exposed to that. They also highlighted bushfires, cyclones, and rising sea levels as growing threats. And we've seen evidence of all three just in the last couple of summers, haven't we?
And with summer around the corner, I really hope we don't have a bumper bushfire season, but we might unfortunately be due.
Aren't you just the king of joy this morning?
I know, this is terrible. I don't know if there's a happy ending. There's a checklist.
And I think also, just for our climate skeptics who might be listening in and considering tuning out, as you just touched on, Mike, there's real change to insurance premiums and there's real change to property values falling or getting less growth. And that's what the practical outcomes that we're going to get to in this episode for people to tune in for.
Yeah, and absolutely.
I wouldn't mind taking an opportunity to take a little tangent, if you both will indulge me, because you made the point, Dave, about climate skepticism, and what I observed at the time, and I've got a couple of extra notes on this, but I was doing some research on what was the peak of the climate kind of debate, and if you go back to 2007, that was Al Gore's Inconvenient Truth, which gave a huge visibility to a scientific consensus, but it also fed a lot of pushback and skeptic coverage. 2 years later, we had the ClimateGate emails. I don't know if you remember that, but there was private correspondence amongst climate scientists that leaked, and it was sparking some claims of manipulation and misconduct, which was really jumped on to fuel the skeptical arguments. Then the UN Climate Conference in Copenhagen in December that year was a backdrop where many skeptics argued very, very loudly. After 2010, we sort of stopped talking about whether it's happening to what we actually do with it. But if you think that debate sort of really started kicking off at 2007, but if you go back to 2004, this is a direct quote from the Association of British Insurers. 2004, climate change will increase flood risk in the UK over coming decades unless action is taken today. 2006, Lloyd's of London, in their Adapt or Bust report, said the climate is changing and human activity is playing a major role. If you look at the Geneva Association in the Kyoto Statement 2009, they said climate change, the latest climate science strongly indicates that climate change is happening. Mankind's influence is very material. So whilst we had a fairly robust debate about whether climate change was a hoax or not, the insurance companies were taking it very, very serious from the beginning. And in a way, it's kind of evidence of there being a problem because they're looking at historical claims figures. They've got their own data point. They're not necessarily looking at climate science directly. I suspect that they would be, but they're just looking at their own data and they're seeing this increase of weather events and premiums. So it's very interesting to note that while the world was sort of going like climate change is a hoax and Al Gore's the devil, the insurance companies are like, this is going to hit us and let's get ready to increase our premiums because it's going to sting.
Yeah. I think with those kind of things, if you're a skeptic, follow the money and look what the insurers are doing. And the people who are going to actually lose a lot of money from these types of circumstances where it may not be common belief that change is occurring. So you go back to cigarette smoking. Is it really a health issue? That first started coming through with insurers, and there's something else major like that where that occurred, that the transition first came with the insurers, and that's what's happened with climate change as well, isn't it?
So, Mike, I want to delve into the insurance premium issue. This is where it gets very real very quickly for a lot of everyday people. What are we seeing in terms of actual premiums?
Yeah, good. Because I didn't want to just have a hypothetical argument. I'm like, well, let's have the real conversation about how it impacts homeowners. The national average, for example, for home and contents in 2023 was about 2,200. But in high-risk areas, it can be quite eye-watering. So I prefaced the Hawkesbury on Sydney's fringe, just north of Sydney on the Central Coast there. The Insurance Council data shows average premiums are over $7,000 a year. year. And in extreme flood-prone cases, people have been quoted more than $30,000. Now, that's not a typo. That's $30,000 a year just to insure the family home.
Yeah, it's a huge cost. You don't want to be surprised by a $30,000 premium after you've bought a house. So in Brisbane's LGA, which we know has had the flood issues with the river that runs through the middle of Brisbane, 2024 Courier Mail report showed average premiums were close to $12,000 a year, with some households paying around $15,000. So that, again, that's more than 5 times the national average. And in floodplain prone Queensland regional towns, so if you think Lockyer Valley, Mackay, Whitsunday, it's not uncommon to see $9,000 to $10,000 premiums as well.
Oh, those numbers alone could put families into mortgage stress. It's like carrying a second set of repayments, really.
And you know, there's the other part of the spectrum that we haven't necessarily talked about is that in some locations you just won't get flood insurance, or it's so prohibitively expensive. Like, I mean, there's a very strong argument to say that 20 or 30 grand is prohibitively expensive, but there are locations where basically it's the cost of the home because the insurance companies see it as such a high risk, or they just won't offer it in that particular location. But in 2023, actuaries reported that the flood risk isn't just a line item, it's more than half the total premium. So flood, as you mentioned, Kate, with that 57% stat, that's the real killer. It's impacts around 170,000 households, where the flood component alone is 8,800 a year. That's big biscuits.
Actually, it'd be interesting to know if someone's recorded what percentage of the properties in the country are no longer insurable. If that's increased, because you'd think would have increased with climate factors as well. So versus just premiums increasing, I mean, that would be another sign.
Yeah, I mean, I wasn't able to find that information. There is a really great data map that looks at flood risk around the country, but it references local studies, so it's very specific to the area. There is an online resource you can go and look at particular areas, and that's a very good thing from a due diligence point of view if you're investing in an area where you're unfamiliar.
So, and then the reinsurers, the big global giants who backstop all insurers, which some people may not know exist. So the insurance companies then actually have reinsurers behind the scenes who support them and back them up. They are pushing up their prices after severe disasters worldwide. So that filters straight down to Aussie households. Allianz reported that in northern New South Wales, 90% of their customers didn't have flood cover. They either stripped it out or couldn't afford it. I mean, that's huge. 9 out of 10. We know there's been massive floods all up around that area. Sort of Coffs Harbour at Lismore is obviously devastated. North and south of that sort of Coffs Harbour, I guess a lot of people know that because it's sort of the major city up there. But yeah, all those sort of regions. I mean, I know I've got family in Nambucca Heads, and feels like they've been just constantly hit with rain the last couple of years. And at Nambucca Heads, the golf course is an island golf course in the middle of the river, just inside the ocean, and it's flooded multiple times in the last couple of years, where it seems prior to that, like it only flooded like every 1 in every 5 or every 7 years or something. So yeah, there's definitely been a huge amount of rain in that region, and for 9 out of 10 people to not have flood cover, I mean, that's
huge, isn't it?
Huge,
that's someone making that decision to self-insure, which is obviously a burden for anyone, because a rebuild, including dealing with foundations, is usually far in advance of where we're expecting it to be in terms of cost. So that's one horrible sting in the tail with all of this. But I want to delve into property market performance in these risk zones, and that, I think, is the biggest sting in the tail, because there will be people that are exposed to these markets who, whether they have flood events or not affecting their specific property or properties, they'll be dealing with underperformance threat as well. So, not only have we got skyrocketing premiums, what are we seeing the market respond to in terms of property values, Mike?
The data is limited, in at least at what I could find, but it is absolutely measurable, and there have been some studies. So, for example, UTS research, which was published late last year, compared sales in Richmond, which, if you're not familiar, that's western sort of Sydney, or way out west of Sydney. Homes in the 1 to 100 year flood zone sold for about 10.8% less than comparable properties outside it. In the lower risk 1 to 500 zone, the discount was still 4.4%. That's not a projection. That is actually current market data that they're looking at. And imagine buying a property only to realize that you're already trying to chase 5 or 10% from the beginning. And, what's to say that 1 in 500 zone doesn't get upgraded to a 1 in 100 year zone, and then you've got, double the impost there. So it's meaningful.
Yeah, and you have a look at Lismore, which is probably the poster town for floods, and probably everyone's seen images of some of the floods that have occurred in Lismore in the recent few years. After the 2022 floods, the low-lying properties dropped by about 30% in value. So buyers are wary, lenders are cautious, and insurance availability is patchy at best.
Other New South Wales areas flagged in 2023 reports like Narrabri, Moree, Forbes and Moama are also facing buyer hesitation. Even in Sydney suburbs like Windsor and Narrabeen, you've got pockets where values are stagnating or falling.
Yeah, and let's not forget that this problem isn't getting better, it's actually getting worse. The Climate Council's 2019 modelling projected that flooding alone could wipe 170 billion off property values by 2050. Now, those forecasts looked very, very extreme at the time, but when you combine them with today's price counts data or price discount data and the insurance withdrawals that seem to be marching further onward, you can see the trend line forming very clearly.
Yeah, scary stuff. Well, let's talk about the broader economic fallout, and zooming out. What does this mean for the broader economy, Mike?
Well, I'd hoped that there'd be some good news in the back end, but I'm sorry to disappoint. In 2022, the Climate Council estimated the disasters were already costing the economy $38 billion annually, and projected that to rise $94 billion a year by 2060 under high emissions scenarios. And we're already tracking upwards. Just look at the insurance industry's recent loss figures after the floods and cyclones that we had in 22-23. These events are hugely costly for the country. And it's not just from an insurance point of view. I mean, just the cost of having water bombers in the air and the emergency services, it really adds up very, very quickly.
Yeah, yeah, and we've got to remember that all these properties that are losing value or are under threat, there are mortgages backing them up. I mean, they are 2/3 of Australians' banks' portfolios, their asset values. So if values crash in high risk areas, that's a problem, not just for homeowners. It can have a systemic financial risk, and guess who wears that? That's every taxpayer ultimately.
Yeah. The lower income households are hit the hardest. And at 2022, at our front door report highlighted that 70% of the most flood exposed homes were in below median income areas. That's exactly where underinsurance and that's exactly where underinsurance and financial stress is showing up today.
We can see from the Insurance Council of Australia's data as well. They report on the percentage of properties that are underinsured and not insured, and there's a huge cohort of people that just have no insurance, and they're much more likely to be lower socioeconomic, much more likely to be immigrants where English is a second language. So it is a bit like inflation in Australia. It disproportionately affects those at the sort of lower socio level.
Yeah, it's scary stuff. I want to talk about government and policy. Are we adapting quickly enough, do you think?
I don't think we are. I mean, research in from builders in Brisbane published in 2023 showed the industry is very low preparedness. Most aren't using climate data in planning. They're very reactive, changing practices when heat waves or storms hit, but not actually proactively designing resilience into the construction designs.
Yeah, and I wonder how closely they're looking at the land that is being built on, um, or is it just really here's some available land, let's build on it and worry about whether it's low lying or flood risk later on down the track. I think there's certainly been evidence of that taking place around the country, unfortunately, and that's what we see in these locations where properties have been devastated with flooding and different, flooding in particular. The National Construction Code as of 2025 still doesn't properly account for climate adaptation. So the Insurance Council of Australia has been calling this out since 2022 and has asked for at least 30 billion in flood infrastructure investment. And it's suggesting that every $1 spent on preparedness will save $10 in recovery. So, but the funding is still not what is needed.
Yeah, so the knowledge has been there for years, but the investment and the coordination have just not kept up. Sad state of affairs. Well, we've gone through the risks, the premiums, and the broader economic fallout. Let's get practical. If I'm an investor looking to buy, how do I make sure I'm not walking into a climate trap, Mike?
Yeah, look, that's a good question, and that's why I wanted to put a little bit of a checklist together, which, as you mentioned before, and we'll chuck it at the back of the episode. If you ping through an email, we can send that through. Step one is to use the data. I referenced before a tool called the National Flood Information Database. There's some great information there. There's local council hazard maps and climate risk reports, like the Climate Council's report at our front door from 2022, which we've been talking about. They're all publicly available. And if multiple sources are saying a suburb exposed, then that should be considered a red flag. I would hate for anyone to be transacting on an investment property without fully understanding what is likely to be hitting them from an insurance premium point of view.
Yeah, and so step 2 in your checklist, Mike, is insurance. So don't wait until after settlement to find out the premium. Ask for a quote up front, before you purchase the property. You may learn something that you didn't otherwise know from the insurance company. You might ask a couple insurance companies to take a look. If a house looks like it'll be 9 or 10 grand a year to an insurer, or a significantly high number relative to the value of that property, that building, and it's something that's really going to impact your cash flow, you've got to second guess why, find out from the insurer, why is it the insurance premium so high? I mean, we've seen investors plug 2,000 into their feasibilities because that's the national average for insurance, and then get blindsided with much higher premiums.
Yeah, it's a really good tip that you've got here about insurance. And it doesn't mean that you've got to go and talk to an insurance broker. It can be as easy as getting online and just doing an online quote. These insurers are well aware of risky areas, and as a matter of course for any of our clients, for example, if we can see that there's a water-related overlay close to or impacting the property, we will just make that part of our process flow. We go on to whatever insurer it is that does an online quote. Sometimes it'll say contact insurer, so they're not even willing to give you an online estimate. That can be a red flag, but you've got to make the phone call. Other times it might show you a cost premium that is in line with something that would be normal in the area for a house that's not impacted by flood overlays or any water-related overlays. But if it's an elevated premium, it doesn't need to be an alarming premium, but if it's higher than normal, that warrants a bit of a closer look and phone call. So it's pretty easy for someone to make this part of their due diligence. It's literally just doing an online quote, and it won't take more than 10 minutes. And you can, or if you're in doubt about whether it's a higher premium or not, compared to similar houses in slightly different areas and just see how they compare. Because if one's much higher than the other, that is always a little bit of an alarm bell for you.
Because they will have modelled it, right? So if you
Yeah,
go to
of
one
course.
particular pocket and then go to another one, there's a big differential. It's
You know.
giving you a peek behind the curtain that they value that area as risky.
Yeah, that's right. It's none of this stuff is rocket science. We're giving some tips that will help people navigate something and highlight whether they need to ask more questions or not. This is just a rudimentary thing to do. Get online, do an insurance quote. And the lesson is to stress test these numbers, model your yield at national average insurance and then again at high risk premium levels. If the deal only works in the rosy scenario, it's pretty fragile, isn't it?
Yeah, and I mean, this show to some degree, especially with Dave's influence, is about planning, right? And it's something that I completely agree with Dave. I think one of the big things that property investors get wrong is they get focused on the property or the hotspot, but not necessarily where they're trying to go and the planning stuff. So this just sort of feeds really nicely into that. Step 3 on the checklist is looking at the build itself, and I didn't put underinsurance on the checklist for fear of bias, because we work in that space and we estimate the rebuild value for homes, and the Insurance Council of Australia is saying that 83% of property owners are actually underinsured for the rebuild cost. Our own data is saying in residential property the average property is 24% underinsured. So you also need to make sure that the reinsured value, or the value to rebuild the property, is up to snuff. But step 3 is talking about the build itself. So does it have elevated floors when they're in flood zones? Because if it's an older established property, to rebuild what's there might not be legal anymore. The codes may have changed, so the construction cost could be an extra couple of $100,000 because it needs to be a metre above the ground level. Things like ember proofing in bushfire areas, having a look at the drainage. Suncorp's 2023 climate report made it very clear. Homes with resilience features are not only easier to insure, they hold the value better, which we mentioned before in Richmond.
Yeah, and look, that's one thing that's really stark when you just drive through outback Queensland like we did, and how much of outback Queensland is prone to flooding. And so how many of the Queenslanders and the houses are on stilts, they're raised. Like that's been the case for 100 years because they know what's occurred in their regions. The land is so flat. So look at common sense and use common sense when you're making these decisions. So then there's also diversification. Don't cluster all your investments in one location, one floodplain or coastal strip. Spread across geographies and risk profiles. Buyers are already paying less for riskier homes. And UTS research last year found a 10% discount in the Richmond flood zones in Sydney, and that will only widen.
And finally, watch policy changes. The National Construction Code will keep tightening, and governments are already talking about managed retreats in places like Lismore. If you buy in the wrong area, you might be forced out or left with an uninsurable asset.
And that's part of the reason why we do this, right? Like, we don't get paid to do the podcast. We just can't stomach the idea of people buying something that sets them back or can ruin their financial future or trajectory. So that's why it might be a very doom and gloom topic and not that much fun, but it is important. We're talking about people's livelihoods here. So with the checklist, to summarize, use the data that is available, get insurance quotes early, check the build, diversify, and watch those regulations. You do those 5 and you should be streets ahead of the average buyer.
That is gold, Mike. And it brings us back to the theme of this episode. Climate change isn't just about the weather, it's about the numbers. If you ignore the data, you're rolling the dice with your money. So we're towards the end of our episode. And in conclusion, climate change isn't just an environmental story, it's a property story, a financial story, and a household budget story. It's really reshaping where people can live and what they can afford.
Yeah, and the timing matters. I mean, these weren't projections from some distant future. They were written in 2019 and 2022. Here in 25, the data shows we're heading down the track they actually warned us about.
Yeah, and so for our investors and home buyers out there, you can read the data and you can read the sentiment and you'll make better choices. So, but if you ignore it or you don't put the effort in because there's so many things going on when you're buying a property and you're getting your finance organised and you don't look into this space that we've invested this episode in, it could cost you a lot of money. So just don't take the shortcuts because, as I say to the kids when I'm at training, when I'm coaching them in sport, the shortcut's the long cut. So, you might be holding an asset nobody else wants in 10 years.
Yeah, well said. Well, thank you for joining us on the Property Trio. We'll be back next week with more insights, hopefully some happier ones, to keep you ahead in the property market. Thanks a lot and great work, Mike, despite the fact that I'm rocking in the corner.
Yeah, I know there's a lot in there, isn't there? But the checklist, that's a good start. And so, Kate, what email address have they got to ping to that?
I'm going to need to do a pre-record for this one. Actually, Mike, can you ask me that question again and don't say email address? Like, how can people get it?
Oh, okay. Yeah, so Kate, it is a little bit terrifying, but the checklist is a good way to sort of steel yourself against the risks. How do people get a copy of that?
Well, there's three ways that they can do that. They can either jump onto our Facebook page and just send us a message, get onto Instagram and send us a message, or jump onto our website, propertytrio.com.au, and there's a contact us form. We'd love to hear from you, and we've got lots of checklists to give out.
And as an added bonus, and you heard it here first, guys, I don't know where else you'd hear it, but we are actually planning an in-person live recording for next year. So if you ping us to get a copy of this, that's also a two-bird situation where we'll put you on the expression of interest list for this event. For people that have sent in listener questions, we're going to favour you and put you right into the red carpet section. For everyone else, we're collecting some details to see what sort of interest we've got in this event, which we're sort of planning for early in the new year. So please get in touch if you'd like to put your hand up to be part of that. And if you do have a listener question in the next little while, perfect time to slide right into that VIP section.
100%. And just to give a little bit more info on this so that it's not like a steak knife ad. We want people to know what's going on. We've masterminded an in-person recording in Melbourne, and it's likely to be in the southeastern suburbs. And if you don't care about the insurance checklist and you don't care about insurance, but you do care about getting an invite to this, it is limited seats. We've got a 30-person venue, so we'll have it'll be fully catered. And we think it'll be pretty special, and it's a first for us. And we'd love to just see a show of interest, people who would be keen to get a ticket, so that we can just coordinate our invites, and we'll certainly pick a date and share some more information closer to the event. But we're circling early next year, so looking forward to it.
Have a bit of fun. We'll mingle with everyone who attends, have some food and drinks. Pre and post the recording, and essentially everyone in attendance will be able to ask us a question. This will turn into an episode, and we might also have another special guest who hopefully who will MC the event.
Yeah, nicely said.
Excited.
We just got to hope he says yes.
February next year, so send through expressions of interest. But maybe we should wrap up there and go into our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
I got a quick little gold nugget. I talked about it in the show, but getting an insurance quote online, I recommend, if you're doing this as a matter of course for lots of properties, so if you're on the hunt and you're doing all of your due diligence across lots of different options, just stick to the same insurer and stick to the same broad set of inputs so that you've got some good data to compare. You're working on one reputable online insurer and you're able to compare apples with apples. If you start bouncing around with different insurers and different premiums and coverage and excesses, you'll probably confuse yourself. So keep it consistent and use all of those baseline benchmarks so that you can see if you've got an elevated premium coming up.
My gold nugget, just to expand on that, is that Kate would never, as part of her due diligence, ignore comparables and just use AVMs to do her job. In the same way, you shouldn't rely on an online calculator to give you the cost to reconstruct the dwelling. So they will come up with a standard figure, and that's fine to use to see what your premium would be and comparing it to other locations and other insurers. But those online calculators are notoriously unreliable for rebuild costs. And it's not just thinking, oh, I saw an ad for a house that looks better than mine, so I'll pick that figure, or I'll just insure for, my purchase price minus what my rateable land value. There's additional costs like cost escalations, tendering periods, demolition, all of those sorts of things. So it is a nuanced thing. And I didn't mention before because it's a thing that we sell, and I don't really care whether we do reports for people. I would rather people make sure that they are adequately insured.
Well, I think it's a really good point because, with mortgages, we see people get building insurance because often the lenders ask for it. And what they insure the building for is often what the building component of the asset is valued at today. But the building value today is often a lot less than it would cost to rebuild from scratch the equivalent building. And that's what people need to think about. You might have a 80-year-old dwelling that it might be notionally valued at $500,000, but to rebuild the equivalent might be $1 million today. So that's what you're talking about really there, isn't it, Mike?
Yes.
Yeah. And look, I just think this episode is a reinforcement to every property buyer about some common sense elements when you're looking to buy a property. Is the land low lying? Is it at a lower point of the street? Is the property behind it sloping down towards your property? So you've got to think about what are some of the risks with the property you're buying. Is it flat land? Is it sloped? Are you near an area that's had bushfires before? Are you buying in the tropics where there's more likely to be cyclones? I mean, these are sort of things you need to consider when you're buying a property, whether or not there is a genuine risk to where you're buying with climate change or not. These are the sort of things you should be thinking about because they have the potential to impact every property in every area around the country. So it should be part of your due diligence and your property planning.
Well, on that note, I look forward to seeing you fellas next week.
Some better news, hopefully.
Yeah, better news. See you then.